quickly give a
This
brief
meeting is being
introduction
recorded.
about global financial consultants. And just to let you know that we have a chat box on. So if you have any questions or any queries, please feel to drop your message there and we will answer you just after the session. So what Global Financial Consultant is a financial advisory company regulated by Monetary Authority of Singapore. It was initially established in year 1997, back in Australia in Sydney. And then the business moved to Singapore in year 2007. And since then, we have been helping our clients with their financial planning, be it any tax efficient savings or investments or retirement planning or kids education fee planning, pension transfers, CPF investments, SRS investments, or any life insurance or critical illness. So, and our main aim is to build a long-term relationship with the clients by giving an unbiased advice. And GFC was recently recognized as one of the top 10 financial advisory companies in Singapore by Singapore Finest. And so that's about GFC. And I will quickly move to our first speaker. I would like to welcome Mr. Brendan Harper. You can see him on the screen. So Brendan is the head of Asia and UHNW Technical Services at Utmost. Brendan's role encompasses Utmost market in Asia and the Middle East, as well as supporting global partners focused on UHNW individuals. Brendan has over 28 years multi-jurisdictional experience, including in the UK, Crown Dependencies, Hong Kong, Singapore, European Union, and UAE, and developing and supporting tax and state planning solutions across various customer segments, including UK, Asian high net worth, Australian, South African, global Indian, and European nationals. Wow. Brendan is the tax committee chairman of the Association of International Life Offices and winner of the STP Worldwide Excellence Awards in 2018 and 20. Tonight, Brendan will be talking about the state tax on US and UK equities for non-US citizens, and also about capital gain tax benefit on the investment via insurance wrapper for NRIs on the relocation to India. So over to you, Brendan.
Okay, thank you, Rohit. Thank you for that great introduction. I don't need to say any more really as a result of that. So I'll just do a quick sound check, Rohit, make sure that you can hear me, and then assume that everyone else can. So I'm hoping that you can hear me.
Yes, all good, all good.
I will just share.
Yes, perfectly fine.
Okay, perfect. Perfect. And I'll just share my screen. Okay. Okay, so hopefully you can all see the slide deck that I'm looking at.
Yes, Brandon.
Right. Okay. It's amazing how when you do things long enough, it all just becomes very normal, doesn't it? You know, I have had the pleasure of doing maybe one or two face-to-face seminars in Dubai earlier this year, but apart from that, like everyone else on the planet, I've been really confined to the internet to do these things. But you know, in some ways, I think it's probably one of the most positive developments of the COVID crisis is that this type of media can now reach people from all over the place. And in fact, today I'm speaking to you from my home in the Isle of Man, and that's the beautiful background I have there is actually one of my own photographs taken on my walk to work one morning. So. You know, anyone who is considering relocating to the Crown dependencies, you know, please speak to me because it is a very pleasant. There are very pleasant places to live. So welcome everyone. What I'm going to cover today is, as Rohit outlined, is just to really give you some thoughts as to, you know, what you need to think about from a tax and estate planning perspective if you are an Indian expatriate. And you're planning to return to India at some stage. And a lot of my time is spent actually helping people to structure their investments for that purpose, to make them much more tax efficient, and also to help for seamless transfer to the next generation. And then I'll sort of point out some topical issues as well around residency that we've had in the last couple of years from the Indian tax authorities. And then I'll look at if you decide to stay in Singapore or somewhere else that's much more tax efficient from a lifestyle perspective, why it's important to still look at your investment portfolios and shelter those from taxes that may occur that aren't necessarily apparent to someone who lives in a low tax jurisdiction. So turning first to planning your return to India. So the first thing I'll talk about is the Indian residency rules. Because they are complex. They're based on very old case law that goes back over centuries. They're difficult to navigate, but if you navigate them in the right way, your return to India can actually be a very tax efficient move back to India if you can manage your residency properly. There's also been a bit of a change in the last few years introduced by the Indian tax authorities to try and clamp down on what they perceive as people who just to move around the globe and don't really have a home anywhere, primarily to avoid paying tax anywhere. And when that came in, it caused a lot of controversy, particularly as it was introduced right in the middle of the pandemic, when a lot of people's residency status was called into question as a result of borders being closed and travel restrictions being put in place. So it caused a lot of controversy, but it actually looks like it's being watered down and softened as it's progressed through Parliament, and isn't actually as bad as it once appeared to be. And then I'll talk a little bit about how you can structure your investments for tax purposes. So turning to Indian tax residency, there's a few concepts three main concepts that you need to get familiar with. We could probably call them the good, the bad, and the ugly, not in the order of the slides actually, but the best position to be in from an Indian tax perspective is to be truly non-resident, and I'll cover as the reasons to why later. And to be truly non-resident, you must spend no more than a certain period of time in India on an annual basis. The other concept is to be resident for tax purposes, so purely resident. And then we have this other one that many people can actually structure their lifestyles around as a halfway house where you are resident but not ordinarily resident. And as I say, there are different rules in place based on an old day counting principle that will determine whether you're resident, non-resident, or resident but not ordinarily resident. And to be resident, there's one blunt instrument rule that says that if you spend more than 182 days of physical presence, so more than 6 months in the country, then you'll be resident. Or if you manage your days so that you can spend less than 182 days in the country, there's a wider anti-avoidance provision that will look at your residency in the country over a 4-year period. And if you average more than a certain period of days over that 4-year period, so 365 days, which roughly works out about 90 days a year in the country, and you spend more than 60 days at the end of the 4th year in India, then you could be treated as resident. And there's a relaxation for that rule for someone who's an Indian citizen or a person of Indian origin, which is quite common in the Indian system, that they will give favourable treatment to citizens and PIOs, where you can spend up to 182 days in India over that 4-year period and not be treated as Indian resident, unless, and this was a change that was introduced in 2020, you are an individual, an Indian citizen with more than 1.5 million rupees of Indian source income every year, then that period will reduce to 120 days. So this is the first time the Indian government has started to really try and home in on globally mobile high net worth individuals to generate more tax income from them. And then the opposite to that, if you spend less than those days in India and don't meet those tests, then you'll be truly non-resident for tax purposes. And then if you happen to become resident, then it is possible to spend less than a certain period of time in India, whereby you don't become what they call ordinarily resident for tax purposes. And that roughly works out over a 7-year period of less than 100 days in India. Okay, so you can see that they're already starting to look a little bit complex. So it is really important when you're planning your relocation to India that you really take advice and understand how those rules will apply to you, and particularly if you maintain a home or business interests abroad after you return to India. And then to make it even more complex, there was a series of changes introduced in 2020. The most important one being a new addition to the Indian Income Tax Act under what they call Section 61A, which basically said that if an Indian citizen who has income exceeding 1.5 million rupees in a year generated from Indian sources, and they are not paying tax in another jurisdiction because they don't live in that jurisdiction, any other jurisdiction, then they will be deemed to be resident of India. And when this first came in, it caused a virtual riot, abroad amongst global Indians, because many people found themselves, as I say, back in the days of the early days of the pandemic, locked out from a place where they maybe spent most of their time because they hadn't regularized their residency status. And I saw that a lot in the United Arab Emirates, for example, where there is a large global Indian population, where many of them had not regularized themselves and got a proper residency visa or working visa for that state, and then they found themselves locked out. And where could they go to? Well, back to the country of their citizenship, to India. So this rule was like a double blow to those people. However, since that change was first proposed, there has been a lot of lobbying, and the good news is that in spite of you running the risk of becoming resident in India, if you fall into Section 61A, you can also retain your not ordinarily resident status, which kind of took the sting out of the tail, because just to kind of clarify why all of this is important, is that your status from an Indian residency perspective determines your tax exposure to Indian taxes. And if you're truly resident, then like many countries, India operates a worldwide income tax system, whereby all of your income and capital gains on sale of investments, no matter where they're generated from, will be subject to tax in India, which is very different to what you may be used to if you live in Singapore, for example, where most types of income and capital gain are not taxable, and only those from sources in Singapore, where they are taxable, are subject to tax. The opposite to that is if you're non-resident, then only income from Indian sources is taxable. And then you have this great halfway house, which allows you to become resident for tax purposes in India. So you maybe enjoy, better benefits and services as a result of being resident in India. However, you will not pay tax on income that is generated from outside India. Okay, so this resident and not ordinarily resident status is something that many people who are relocating to India try and put themselves into, certainly in the early years of their transition back to Indian residence. Okay, and again, why is that all important? Well, because the personal income tax rates in India are high by the standards that you may be used to when you live in Singapore, or indeed if you live in the UAE, where there's another large Indian population. As you can see there, that the headline rate of tax is 30% on income, but that actually hides the reality, because the Indian tax system is complex, and in addition to the higher rates of tax, once you have higher rates of income, then there are surcharges that are added to that income tax bill. So effectively, they take a percentage of the income tax bill that you get at the end of the year, and they add that to the bill. And there are two charges. There's a surcharge, and then there's what they call a cess for education that gets added to that as well. And they can go as high as, so the surcharge can go as high as 37% of the income tax bill. Once your income goes above 10 crore, which is roughly about 1.6 million Singapore dollars. And the education cess is 4% of that liability. So that brings the overall headline rate of income tax in India to about 42.7%, which is, much higher than what you will be used to if you live in Singapore, where the highest rate of income tax is 22%. And most types of investment income, which is what you may be relying on for retirement, is not in fact taxed in Singapore at all, whereas all investment income and capital gains is subject to tax in India. And so just a little comparator there, if you're thinking of moving to other jurisdictions that are popular with global Indians like Australia or the UK, then bear in mind that you need to plan for those jurisdictions in a similar way to your plans for India. And then another aspect of your move back to India that you mustn't ignore is that it's one of the few jurisdictions left that still has an exchange control. So that prevents you from taking money out of the country to live on. So it's important that you're aware of how that impacts on wealth that you have generated whilst you were resident outside of India. And the good news is that it can be structured in a way that generally it does not need to be brought back in to India, which is really important if you want to keep access to foreign currencies, for example, to hedge against the volatility of the rupee. And then in terms of foreign assets, if you are Indian resident, as I said, your wealth is taxed on a worldwide basis. So and what type of return you are receiving from that wealth will determine what rate of tax will apply to it. So on the left hand side, if you had a very typical stock portfolio, then any income that is generated from bonds or structured products, or dividends that are payable on shares, or the return if you sell shares and you have only held them for less than 3 years, then all of that is treated as income in India, and it's not enough to keep that wealth outside of the country. If you're resident, you will be taxed regardless of whether it's in the country or not, and regardless of whether it's brought into the country or not. And that rate of tax can go as high as 42.7%. The good news is, however, that if you hold assets that create what we call long-term capital gains, which are capital assets that are held for more than 3 years, then there is a reduced rate of tax known as capital gains tax that has a rate of 20%. And so if you're in the very wealthy category, then it's really important to try and turn that investment wealth into capital gain rather than income, and that's where structuring becomes really important. And then also in addition to the tax benefits, it's really important that you structure your wealth in a way that you retain it in a stable and well-regulated jurisdiction. And obviously, maintaining your wealth in Singapore will achieve that goal, as it is a well-regulated jurisdiction with a stable government and a stable currency and a stable economy. So there's no need to give up your relationships with your advisors in Singapore when you return to India. And then it is possible to structure those in a way that you can have access to the assets anywhere. They're portable from a tax perspective, so they work in other jurisdictions like Australia or the UK, for example, and that you can pass on that wealth seamlessly to your family members. And how we do that is through using Singapore insurance policies as a mechanism, so investment-linked policies, and some of you may already have these advised by GFC, which allows you to hold that investment portfolio in a way that it looks no different from a normal investment portfolio in terms of the strategy and what you can invest into. However, it is wrapped in the form of an insurance policy. So the contributions are paid by way of premiums. You can have access to the money at any time through withdrawals, and all of the income and the gains that happen and arise from the investments underlying the policy accrue into the policy, ready for you to use them as and when you need them. And doing it that way creates, that very simple structure actually transforms the profile of the investments from a tax perspective. Instead of having to declare and pay tax on dividends every year, for example, or to declare and pay tax on capital gains when you sell an asset or your asset manager sells an asset, the insurance envelope allows those returns to build up inside it without the need to declare them or pay tax on them until you're ready to take money from it. Okay, and we call that gross roll-up or tax-free inside build-up. In terms of succession planning, the Singapore insurance investment-linked insurance structure allows you to nominate beneficiaries, and that's a really simple mechanism for ensuring that when you're no longer around, that those assets will pass seamlessly to the next generation or to your chosen heirs. And they will pass outside of your will. There'll be no need to go through expensive probate or estate administration. Your heirs will receive the money timely and maybe at a time when they really need that money. And also you can structure a nomination under Singapore law for the benefit of your children or your spouse in a way that it doesn't form part of your estate, even in the event of a bankruptcy. So it's very common for people who work in professions where there may be a risk that a litigation risk. So people in the medical profession, for example, it's a way for them to protect family wealth just in case they face a bankruptcy in the future. And then all of that simplifies your affairs and allows you to retain investments in foreign currency as well. And then when the money does emerge, so if and there will be two ways that you can take your money. Either you can take a withdrawal or surrender the policy and take that money and live on it. And then from an Indian perspective, those gains are subject to capital gains tax. So as long as the policy has been held for more than 3 years, you are reducing your overall exposure to income tax from 42.7% to 20%. And it will actually be less than that, because how capital gains tax works is that the cost, so the capital that you put into the asset, is deducted from the return. And if you've held it for a long period of time, you will also be allowed to adjust that cost basis for inflation. And obviously inflation is a very hot topic globally at the moment. So the ability to rebase your capital in accordance in respect of inflation, will reduce the overall tax exposure on those gains. And then finally, this year, there's been a change announced that the maximum surcharge on capital gains, long-term capital gains, is 15%. So a lot lower than the 37% maximum surcharge that you get on ordinary income. So overall, it reduces the tax exposure from a potential 42.7% to about 23.7%. So that's the difference between a comfortable retirement and one where you're paying most of your retirement income away in taxes. So it's really important to understand the structure before you go back to India. And then finally, if the benefits emerge to your beneficiaries in the form of a death benefit payment, then they are not taxable in India. And then you also have the fortunate position that only in very limited circumstances in India are there any inheritance taxes. We need to plan for inheritance taxes for other nationalities, but if you're moving to India, then inheritance tax is not necessarily something that you need to be aware of, other than if you own equities or investments in other jurisdictions where they do have estate duties or inheritance taxes. And two very common examples I come across are people who have exposure to US equities or to UK equities. Both are very popular places to hold, in which to hold part of your portfolio due to the size of their stock markets. And it's not always apparent to people who live, particularly if you live in Singapore or India, where there is no inheritance tax, that you could accidentally create an inheritance tax liability for your estate. And just to explain why that is, as you can see here on the left-hand side, the US estate tax rate, the highest rate is 40%. On the right-hand side, the highest rate of inheritance tax in the UK is 40% as well. And in fact, in the UK, on death, it is a flat rate of 40%. There's no step-up system where it starts lower. Once you exceed the maximum that you can leave tax-free, which is 325,000 sterling, it's a 40% liability. And interestingly, that rate of inheritance, the allowance for inheritance tax, has not changed since 2007. So here we are, 15 years later, and the tax-free amount is still the same amount. And what has happened to asset values in that period? Well, they've gone up massively by inflation. So every year, more and more people are finding that their estate is potentially facing inheritance tax in the UK. The US is more generous. Each individual can leave up to just over 12 million US dollars free of an estate tax. However, that only applies to US citizens. Okay, if you are what they very charmingly call a non-resident alien, so anyone who's not a citizen or a green card holder who owns assets in the US, that 12 million US dollars estate tax exemption drops to 60,000 US dollars. And that's where the trap comes in. If you own stocks and shares directly in your own name, or through a banking platform, for example, if those shares pass to your heirs on death, they are US assets for estate tax purposes, and there is only an exemption for the first 60,000 US dollars. And then likewise, if you have UK shares, then generally there is only an exemption of up to 325,000 sterling that will pass to your heirs. So to give you an example, if you had someone who's resident in Singapore, widowed with two adult children, and they have a share portfolio worth 1.5 million US dollars in US shares and a 1.5 million sterling portfolio in UK shares, just to illustrate what would happen. This is the US one. It looks pretty complex, but on the right hand side, you can see that it's 1.5 million US dollars, less the 60,000 exemption. The rest, the 1.44 million, is taxable, and then that is put through the big range of thresholds that they have for US federal state tax, and you can see that the bottom right hand corner of the table, that overall there's an estate tax liability of $521,800. So about a third of the estate is taken in accidental estate taxes. And then likewise, you know, in the UK, we've assumed that as the person is widowed, that they can inherit their former spouse's exemption as well. So give them a much more generous exemption of 650,000. However, it still creates a tax liability of about a fifth of the estate at the value in accidental inheritance taxes. So again, that's really easy to plan for. And the reason why that is easy to plan for is if you use Singapore insurance contracts, you are no longer the owner of the underlying assets. You have control over them. You can select them. You can buy and sell them. You can appoint someone to manage them for you. You can take the money out anytime you want, and you can nominate beneficiaries. But the insurance company is the legal and the beneficial owner of the assets. And that simple transfer of ownership means that on death, it's not the shares that are paying out or the value as a result of the transfer of the shares or the sale of the shares. It's the death benefits arising under the insurance policy. And as the individual is not a UK national or a US citizen, then there is no inheritance tax or estate tax to pay on that transfer. So not only does it provide you with perfect shelter for your return to India, but no matter where you end up in the world, if you are exposed to international investment portfolios, it can actually help you to rearrange your affairs in a way that makes those investment portfolios much more tax efficient as well. So that concludes my part. I'll just leave you just with a word of advice that if you are planning to move, don't delay the estate planning to the last minute. It may be too late. Seek the advice early and seek the advice of an independent financial advisor like GFC, who can give you qualified advice under the Singapore regulatory regime. And thank you.
Perfect. Perfect, Brandon. We have quite a few questions I can see in the chat box. So I will start with the first question. It says, if I have investments in Singapore with DBS Bank and I transfer those through GFC to life insurance wrapper, do I have to pay tax on gains accumulated after relocating to India? Brendan, you're on mute. You're on mute. Sorry.
Sorry, I said I was so used to doing this. You'd think I would control to make it work the controls properly. Again, yes, it depends on your residency status. So if you're a resident, then yes, you will pay tax on those gains because you will pay. You'll be subject to tax on a worldwide basis. Okay, and the transfer of the DBS portfolio to GFC and into the insurance wrapper would be considered to be a disposal for capital gains tax purposes. So that's why it's important to do it before you become resident. Or, however, as many people are, it's very common, if you are resident but not ordinarily resident, then it would be deemed a disposal of overseas assets, and again, it would not be subject to capital gains tax in India. And now you're on mute, Rohit.
Sorry. Okay. Second question is, I have US company shares via my company and investments in US equities with trading platform like Interactive Broker, DBS, and Morgan Stanley. Will I incur inheritance tax?
Yes, yes, and the reason being that if they are shares in a US company, so anyone who holds Microsoft or Apple or Google, for example, potentially has a US exposure to US estate duty. And this whole area of holding it via a platform like a private bank or an investment platform, what's actually happening legally is that they are the custodian or the legal owner of the investments, but the client or the owner of the account is the beneficial owner. And the estate duty is determined by the status of the beneficial owner, not the legal owner. So in some ways, it's kind of a massive accident, I think, that's waiting to happen. You know, the US authorities really haven't caught up with this whole world out there that are holding stocks on platforms and in private banking custody accounts where the estate tax is not being declared. You know, the death is not being declared and the estate tax is not being collected. Personally, I think it's only a matter of time. And the reason why is because they have so much more information at their disposal now because of things like FATCA, for example, and qualified intermediaries legislation. So yes, the answer is yes, and I think it's only a matter of time before they catch up with those accounts.
Okay, great. Another question, does US domicile ETF also consider to have inheritance tax?
Yes, because it's a share on a US share, so therefore it also is.
Okay. Last question. Could you please explain gross roll-up?
Okay, so gross roll-up effectively means that it's a return that you get with no tax. So it's a gross return, and you know, to compare, if you have an investment account, and many of your clients may already have an Indian investment account, for example, or a stockbroking account with DBS in Singapore was mentioned as well. As you are the beneficial owner, if you live in a jurisdiction that taxes worldwide income and gains, then every year you will receive a statement from the platform provider that will break down and itemize all of your investment returns and what category they come from. So are they interest or income? Are they dividends, or are they capital gains generated from the sale of a share? Okay, and if they're capital gains, are they long-term or short-term? And all of that is itemized, and then you're meant to put that on your tax return, and then you pay tax. Okay, so that is a net return effectively that you're getting every year on the investment growth on your portfolio. If you structure your portfolio into something like an insurance bond, then you only pay tax when money emerges from it. Okay, so all of those items of return that you're receiving on your portfolio are rolling up gross with no need to pay tax on them. And that's what we mean by a gross roll-up.
Okay, great. Perfect. I think that's it. But in case if any of the attendees have any more questions, feel free to drop out and we will answer at the end or maybe via email. So thank you so much, Brendan. Thanks a lot for your time and for a great presentation. It's always worth listening to you, and especially about reducing taxes. Who doesn't want to listen? So thanks a lot. Thank you so much.
Thank you.
And so we will move to the next speaker. Up next, we have Miss Janice Cheah, who is a manager in business development at Sing Life with Aviva. She has graduated from RMIT in business finance and has a wide working experience in bank, insurers, and stockbroking firm. She has been in business development role with Sing Life and Aviva for the last 8 years. Wow. So over to you, Janice.
Thank you, Rohit.
And yeah, sorry to say, but she will be talking about safeguarding yourself against the cost of critical illness. So looking forward to hearing you, Janice.
Thank you. So before I start, just can you guys see my slides?
Yes, Yes.
Okay, thank you. Very good evening to everyone. Okay, my topic today is actually safeguarding yourself against the cause of critical illness. So is creating a thought where you can actually do an assessment or have a discussion with GSC advisors to determine if your critical illness cover is actually up to date. Do you have the latest coverage that is good enough to actually sustain should something happens to you? Okay, let's look at some fun facts before I actually start the session. How many of you guys actually, when you look at this slides, how many of you guys find that it's very familiar? So day in, day out, some of the food that we actually are having is looks familiar. For example, do you know a can of soda actually does contain 10 packets of sugar? So studies have actually shown that by drinking at least or by drinking 2 soda per week, nearly double the risk of pancreatic cancer. So how many of, don't have to actually share with me in terms of the answer, but you yourself will know how many cans of soda actually you consume. So what does the image here actually tell us? Studies actually have shown that lack of sleep does actually increases the risk of colon cancer. There are some studies from the States that we actually pull out from this article to show that for people who actually constantly lack of sleep are actually in relations to actually suffering from some top cancers that are actually related to breast, prostate, as well as colorectal cancer. So then it brings down into the agenda where the topic is cancer is the #1 killer, and then the reoccurrence is real. So early detection can help to actually save life, and then as well as some of the big misconception that we ourselves may have, or some of the blind spot that we may have, as well as what are the points that you should look out for when you're looking for a critical illness plan. So all this can be discussed with the advisors that you have. So cancer is the #1 killer. Why do we say that? From the articles that we pull out from Straits Times previously, the article actually shares that every day in Singapore, there are about 36 people that are told that they are suffering from cancer. So this is actually quite alarming numbers. So, and also from the article itself, right, it actually shared with us for people who actually suffered previously from cancer, it does increases their risk of actually suffering from stroke as well as heart attack. So this is article where we expanded to actually show a new diagnosis of cancer is associated with doubling the risk of actually stroke and heart attack. And we also pull out statistics for critical illness, be whether it's for male or for female. Cancer is the #1 killer or #1 critical illness claim based on what we share here. So of course, we also have the heart attack, which is the ischemic heart disease and stroke. So regardless of male and female, these 3 conditions are actually the top claims for critical illness. So critical illness from the insurer perspective, it accounts for almost 50% of all the claims. And from the statistics that we actually pull out, it shows to us that about 1/3 of the patients not only just diagnosed with one critical illness, but the claim actually is more than one. So from the past claim statistics that we have, it actually also shows that the claims for cancer for 2015, for 2016, it is actually more than 70%. This is actually very alarming compared to the rest of the critical illness. So we need to make sure that our coverage is actually up to date. And the next few slides that I'm going to share is actually basically telling you that the client who actually suffer or the people who actually suffered from cancer, not only just claim once, there is actually cancer that are recurrence. From this article that we pull out or what we are sharing is this person actually is actually a second time cancer patient that is fighting for cancer. He actually battled, or his diagnosis of the cancer, the first cancer was 16 years ago, where he actually suffered and then went through a suffered from cancer and went through a surgery where he have actually chemotherapy. And then he was actually fighting for the to be one of the cancer survivor. So after won the battle, after he won the battle, he actually became very active in terms of exercising to make sure that he has good health. But however, 16 years later, he was shocked to receive that there is actually a relapse of a cancer. So experts actually share with us that 1 in 10% who may get multiple cancer in their lifetime, the moment where the person actually diagnosed with first cancer. So it actually increases the risk by 20 to 30%. Colorectal cancer patient typically faces a relapse of the cancer within 3 years after the surgery to remove the tumor. So this one will actually increases the risk of up to 70% if their diagnosis is actually severe cancer. So, and the chances of recurrence for those who actually in a better position, which is actually under stage 1 and stage 2, we call this the early cancer, is about 10%. And then the relapse is probably the relapse for stage 2 will be actually 20 to 25%. So with this article itself, right, this paragraph actually shows us that if you suffer from early cancer, the chances of relapse will be lower. However, if a person who was diagnosed with severe cancer, then the chances of relapsing is very high, especially for people who suffered from colorectal cancer. So early detection does actually help to save lives, because with the medical advancement, so more and more people are more health conscious, so they go for health checkup, so which actually helps to actually detect more cancer patients or more critical illness. So let's look at the Q&A here to do a test for the understanding whether is it true or false. Okay, majority of the breast cancer were actually stage 3 and 4. Is it correct? True or false? So basically the answer is false. Because of the medical advancements, majority of the diagnosis for breast cancer were actually early stage, either stage 0, stage 1, or stage 2. So if it is a stage 0 or stage 1 cancer patient, you have a higher survival rate. So with medical advancements such as mammogram, as well as pap smear test, it actually helps to save life because of all these tests, there is actually early detection of suffering from critical illness. This article actually shows us that the lady basically suffered from cervical cancer. However, because of the medical advancement of technology, so she was being saved and she was free from cervical cancer after the surgery. So new drugs also give hope to lung cancer patients due to the medical advancement. The article was actually sharing what we are sharing, or what we pull out from the stats. It actually shows that more and more people actually in Singapore suffered from cancer, but however, the survival rates also go up. So because of thanks to the medical advancement of technology, it actually helped to prolong the survival rates for people who are suffering from cancer. So with medical advancement in medical technology, early detection actually leads to the higher probability of recovery. So with early detection of critical illness as well as cancer reoccurrence, which actually happens in many aspects of our life. So just a checkpoint whether is your insurance plan ready for it. So there could be some of the insurance plans that we bought many years ago that may not be ready for the current medical definition. So we use this article as an example. This lady who actually unfortunately suffered from breast cancer. She actually went through the battle. But however, after she went through the surgery, the chemotherapy, where she actually tried to claim from the insurer, she thought she has bought 3 policies. But however, sadly to actually realize that her coverage actually does not pay or does not cover for non-invasive early stage cancer. Her condition was like the diagnosis was actually early stage, but unfortunately none of her policy does cover early stage cancers. So was it her or was it her insurance plan that were not ready and she did not manage to actually buy any additional cover to actually cover for early critical illness? This is one of the very good example for a point check for all of us to actually speak to any of the financial advisors from GFC to actually have an understanding or to have a review for our plans, whether is our insurance cover actually up to date. Has our insurance plan caught up with the medical advancements and the life challenges ahead? So let's look at the big misconception that some of us may have. I already have a hospitalization plan. Hence, I may not actually require any of the additional critical illness cover. But however, by having a hospitalization plan, does it mean that it covers the replacement for the loss of income in the event if I'm sick? In addition, does it help to actually pay out or helps to cover in the event if I decided to go for overseas elective treatments? So these are some of the pointers that we may actually think about whether does our hospitalization plans or does our addition of our cover actually helps to actually provide for all this. For replacement for the loss of income. From the survey that was actually pulled out a couple of years ago, the respondents who actually took the survey actually fears that there's a loss of, in the event if they suffer from critical illness, they fear that the financial may have an impact on the family. And in addition, they fear that their critical illness cover may not be enough to cover them in the event if they fall sick. So from the article itself, it actually tells us that on the average, to treat a critical illness, you likely may require higher amount. And for all the people who actually taken the survey, most of their critical illness cover may likely fall below the required amount of below 150,000. And how long through the survey, it actually shared with us that it takes about 3.5 years in order for the person who actually falls sick to get proper treatment as well as to rest to recover their health. So let's take a look at this. How much is the average monthly household expenditure in Singapore? These numbers that we pull out was actually the survey done in 2012 and 2013, and the numbers may actually go up based on the average monthly expenses. So from 2012-2013, a Singapore resident household actually spent on the average about 5,000 a month on the expenses. However, given in today's terms, the expenses for each household may even double up to 10,000 depending on how big is the family. So we just use the average monthly household expenditure of 5,000 as a gauge. So for the replacement of loss of income, what if Michael only has 100,000 of critical illness, and should something happens to him, in the event if critical illness were to strike him, how much would this 100,000 actually last him? So let's presume that Michael is a breadwinner, and he still have to take care of the family money expenses while he's actually fighting for the battle for the critical illness as well as trying to recuperate his health. So average monthly expenses, if it is a $5,000 average per month, the 100,000 sum assured that pay out for the diagnosis of critical illness may only last him for 20 months. If your monthly household expenses is 15,000, then this 100,000 can only merely last you for 7 months. Is it a good enough gauge? Is it good enough for you to actually help your family to tie through over the financial impact? Remember, the earlier survey says that, or tell us that it takes about 3.5 years for us to actually fight through a critical illness, as well as to recuperate our health. So this is a good gauge for us to actually think through, is our critical illness cover sufficient should something happens to us? In addition, how about overseas elective treatment? If you're not able to get a good treatment in Singapore, would you prefer to actually opt for a treatment overseas? Does your hospitalization plans or does your cover is good enough for you to actually get a treatment overseas? So we know that US is one of the countries that is actually very good for cancer treatment. So should, unfortunately, we are being diagnosed with rare cancer, then do we have enough money in order to get the treatment overseas? So this is the wife of our former minister, Mrs. Yeo, who unfortunately suffered from a very rare cancer, and then she opted to get treatment in US. So how many of us have sufficient critical illness cover in the event if something happens to us, then we got the payout and we can be like her to actually get the treatment in US? Then it boils down to my next question. It boils down to my next point on what are the things that we should look out for when we are planning for a critical illness plan. Don't settle for less where there is where need is most needed. So you should look for the best plan in the market where it caters for your needs. So ensure that you are covered enough where you need it most. So for example, this article, her father was who actually suffered from stroke when she was actually 21. So she has to actually give up whatever her life is to take care of the father. So being a caregiver, she will not have an income, and at the same time she has to take care of the sick father as well as the family. So should something happens to us, we will need one of our loved ones to take care of us. So we also hope that we can relieve the financial stress away, knowing that our loved ones actually take care of us while facing emotional stress. So we want to make sure that our critical illness plan do have enough, or we have enough payout in order to take care of ourselves, and at the same time we can help to take care of the family as well as the caregiver. Point to look out for: don't settle for less. Do enjoy the total payout of 900% of the sum assured for critical illness. So when you have a discussion with your financial advisor, make sure that you have a review on your critical illness to actually ensure that your plans does allow or does have sufficient cover for all stages of critical illness. Why do we need to have sufficient cover for critical illness? And why do we need the coverage for early critical illness? In 2014, statistics actually show us that 1 in 3 Singaporeans actually die of cancer. And in 2020, 1 in 2 will develop cancer in our lifetime. So with the medical advancement, so early detection will lead to actually higher probability of recovery. So it actually which means that it's telling us that there will be an early detection. So in the past, people do not go for health checkup often. So the detection of the critical illness would likely be the severe stage. However, with the medical advancement, the detection of critical illness will likely be the early stage, like stage 0, stage 1, or stage 2. So we pull out this statement from Dr. Wong, who is actually from the Cancer Center, shared that 1 in 10 people will get a separate cancer in their lifetime, which is telling us that recurrence is actually possible. And then for those people who previously diagnosed with cancer, it actually increases the risk by 20 to 30%. Likewise, for people who suffered from breast cancer, it actually, as long as they only have the removal of one breast, so it still has an increased risk of suffering from breast cancer the second time. So for the breast diagnosis of cancer, every year, it depends on their stage of diagnosis. If it is stage 0 to stage 1, where it is actually a very good recovery, the risk of diagnosis of cancer may increase by 1% per year. And points 3 that we should look out for when we plan for our critical illness coverage is, what if my cancer cell spread to another organ? Can I claim? And what if I claim once for my early stage cancer and I'm recently diagnosed with late stage cancer? Can I claim? So these are some of the questions that you may have, or where you actually, when you look for critical illness plan, make sure that you cover all aspects of the plan to ensure that your critical illness plan is actually the most updated and actually cover from critical illness to actually severe stage critical illness, not just only for cancer. So in the market itself, we do have a plan that allow you to do multiple claims. So if there is actually any interest to actually find out more, please talk to the advisor from GSC. So always look up, or always make sure that you have critical illness plan that allow you to actually have a subsequent claim for cancer, or to allow you to have a subsequent claim for critical illness. So these are the, earlier on where I share these slides, some of us may be a culprit of like drinking alcohol or having a wine every week, drinking soft drinks, or even thick processed food like processed white flour, popcorns, or even processed meat. So all these foods are actually 16 potentially cancer-causing food that we, if possible, should avoid. So in terms of financial planning, all of us are responsible for our own action. So I urge you guys to actually take charge and start planning early. So should there be a need to talk to your, to actually have a review, please speak to any of the advisor in GSC. We not just only needs to plan for our financial, we also need to make sure that our insurance cover are well taken care of, so that should something happens, we can actually take the financial stress away from our families. So with this, I will end my sharing here.
Thank you so much, Janice. Thank you so much for your time. It was lovely hearing you. So if anyone has any questions, please. Yeah, we have just one question. Is multi-pay expensive than normal critical illness?
Okay, it is very different aspects. If multi-pay critical illness does actually cover only 36 critical illness, 36 major critical illness, and once there's a claim, one-time payout and the policy will lapse. Multi-pay allows you to cover up to 900% of the sum assured, which actually cover different stages of critical illness from early to intermediate to actually severe stage, and allow you to do multiple claims for severe critical illness. So if you were to ask me whether is multi-pay more expensive, I wouldn't think so. Being a cancer patient myself who actually suffer from early stage cancer, I would actually want to have multiple claims, or I would want to have a critical illness cover that allow me to do multiple critical illness claim, because I believe that with the medical advancement, the diagnosis of a second critical illness is possible. Yeah.
Okay, perfect. Thank you so much, Janice.
It
was really insightful. Thank you so much, and definitely very alarming. So thanks a lot. Thank you so much. We will now move to our next speaker. I will welcome Deepak Singh. the man behind the webinar and the seminar and all the events in GFC. So I will quickly give a short introduction about Deepak. He is a director at Global Financial Consultants and has been with GFC for nearly 8 years and has established himself as one of our top performing consultants. He specializes in financial planning, insurance protection for individuals and groups, as well as advising on CPF investments. Deepak currently has an asset under management of approximately Singapore dollar 85 million. So over to you, Deepak.
Oh, thank you, Rohit. Can you hear me?
Yes, you are audible.
Okay, great. So thank you, Rohit. Thank you very much. And good evening to everyone. I hope you're enjoying the session today. Apology, we had to move from a seminar to webinar at the last moment due to the case that was rising. Hopefully, we'll come back to the physical seminar soon. We have already done 2 seminars in the past, so hopefully we will look to do another one in the coming days. The idea of this seminar was most to educate the investors, the clients, and the prospects about the various topics. And where Brendan, I have worked with Brendan personally quite from our last 4 to 5 years, understanding his knowledge and transferring to my clients. So the key features were like a US state tax from Brendan Talk, which is very important when I was advising my clients, the clients who actually work in all the US-based companies, you can say from UK or, I'm sorry, working for the US-based company like Microsoft, Google, Amazon, and Johnson and Johnson. They always get a stock rewarded, but they were not aware about this US inheritance tax, which was an eye-opener for most of my clients. And also, everybody like to invest into US market, which can be diet stocks, equities, and the ETFs, which has done quite phenomenally well since last 7 to 8 years. They were not aware about that inheritance tax too. So it's quite a bit. If you see the numbers, if you're holding more than $500,000 UST, there's only 60K exemption is given to that, and the tax goes to $500,000, which is a liability to your loved ones, which you're going to pass to the money in the future. So we provide a solution for them, and we try to work with our clients so that how can we avoid that. And more importantly, which is the key thing is here is also the concentration risk, which is your most of the assets into the one single equity. So I'll just give you a scenario. A client who has been working with Google, and which is mostly from the last 7 years, they have been accumulated their wealth into one single stock. And from their portfolio perspective, it can be 40% of the net worth asset. And suddenly this year, if the market falls down by 22%, which has happened with most of the tech stocks, suddenly your net worth was fall down more than 22%. So the idea is to also diversify your single equity into a different instrument so that you don't get a concentration risk on that. That's the one thing which we advise from our clients on a daily-to-daily basis and a long-term basis. Second is a relocation. Most of my clients are Indian expats, and they're going to go to UK, Australia, or States. But if they're planning to retire in India, as Brendan explained to you, is if anything, tax can go to up to with 43% and up to 37 to 43%, which is quite a huge money, a huge tax you're going to pay. So the solution which we provide from a portfolio bond or insurance wrapper, which is nothing changes, you have still a flexibility to invest into different markets according to your risk profile and time frame. Everything remains same, the ground will remain same, but at least you can save your tax from 43% to 22% or 23% on that. But remember one thing, there's also FX conversion going to take place on the portfolio. So you're not only getting a conversion from a gains, also from a FX perspective. I don't know, but we were just looking at a chart in the last few years, and we are expecting to reach the dollar conversion from 55 to 64 from SGD to INR, which is going to be a big jump in the coming 8 to 10 years. So Yes, we need to plan the wealth according to their objective, time horizon, risk profile, but we also need to keep these other different aspects. That's where the Brendan comes into the picture. And we work closely with Brendan and other providers to give you this information on that. Where I say the wealth accumulation part, where the wealth protection, Janice has given a very broader idea that how important is term insurance or critical illness plans are very important. I think every individual need to have one, not from the company, but from the personal perspective. Um, if you have bought an insurance 5 years back or 7 years back, I will strongly advise you to go to your advisor or come with us to do a little a review on your health insurance side or medical term insurance side, so that at least you know that is any coverage required more on that. There's a lot of plans in the market, which is called multi-pay, which Janice was trying to give an explanation that a lot of people is getting a cancer or some critical illness. There's a remission, and again, there's another type of a cancer occurs. So is it we have enough wealth to cover this, or we need a plan for that? So please, this is very important. I just say health is wealth. So keep evaluating your plans with your current advisor, or pretty much happy to chat with you one-to-one to discuss on that. From a GFC perspective, Global Financial Consultant, we do work with every individual, just like you, and we try to work with their objective, which is depending on their short-term to long-term horizon investments, and from our wealth protection side also. From a market perspective, I just want to discuss with you, I don't know how many people you have invested your wealth, but this year is not started quite well. It's been quite a hedgy start. Everything has fallen down since January till up to May. Sorry, June. You can say that S&P has fallen down almost close to 22%. Nasdaq is falling down to 31% by end of June. This has happened after 50 years back, and which was in 1972 last time. And the markets has reacted a very different way for a various reason: inflation, high interest rate, Ukraine, Russia giving the pressure on the energy prices and the food prices on that. So there's a lot of confusion. There's a lot of stress is in the market. But what we're doing with our clients is we always advise our client to stay invested for longer term. And when I say longer term, we need to know what's your horizon of the investment gonna be. This graph, I'm just trying to give you a show, like this is one of my clients who invested since 2016 in May, and today value is still in the 052282. The average monthly return on the portfolio is around close to 0.80%, which is, if you say on annualized basis, is around close to 8 to 9% annualized growth. There's a little dip which you see in the portfolio in the last 6 months. But if you plan accordingly in a capital accumulation period, capital protection period, and capital realization period, what I meant by that, like if you're looking to invest, if you have a time frame of 10 years, you don't need to panic. Just keep buying. Make sure that your assets which you're buying are pretty much matured and you're going to make sense in the long run. Capital protection period is where you start relocating and reassessing your portfolio when you're realizing the funds. It will be a very unfair to the clients who need money in the month of June or March or April, and you are sitting down in equity market. You would have must have lost a lot of money in the last 6 months. So that's where the readjustment of the portfolio and rebalance of the portfolio required, which we do with every individual client according to their short-term and long-term need on this. This is a very important aspect. If you invest in the right assets, stay invested. If you're invested into a long-term assets, stay invested until there's a fundamental and a background value is right. But if you need money in 3 to 4 years, start looking into your wealth, that where are you alignment of portfolio is. Because the key thing is the year from 2008 till now, there's a lot of liquidity in the market. Interest rates were pretty much minimal. Now it's going to go up. So you need to redesign your portfolio and just to look into this. When you need money, you're not sitting in a negative value on this. This is what I do with my individual client or GFC clients. We're looking at a similar structure on that. So as a company, we deal with the providers like Utmost, Quilter International, Singapore Life, and Aviva. They were different providers. We give unbiased advice, which we understand your particular basic need, and accordingly we advise on their solution according to the client's requirement on that. I'm happy to sit down with every individual client or every individual prospect if you want to know more about GFC and how can we help you with that actually. I hope you enjoyed the more session. The session was left with Vivek, which is a very interesting person. He gonna advise you something apart from financials and apart from the tax, but it's more about how to deal with the millennials, not into your corporate, but more importantly into your corporate and your normal life too. Very basically, I learned a lot. I'm a millennial, but I don't learn a lot how to deal with my own workers. So I hand over to Rohit, and I hope guys you enjoy the session and take care of yourself. Thank you.
So up next, we have a very interesting topic, and we have Vivek Iyyani. He's a millennial keynote speaker. He is a professional speaker at Millennial Minds Private Limited. He is the author of the book Engaging Millennials and has spoken at organizations like the Oracle, Julius Baer, Schroders, New Skin Enterprises, Great Eastern, and Booking.com. He has been featured by the National Population and Talent Division, NPTD, under the Prime Minister office in a video of My Singapore Story. He has appeared on channels News Asia twice as a guest of Millennial Topic. Vivek is known in industry to speak around the globe in conferences on how to recruit, reward, and retain millennials at work. So, looking forward to hearing you, Vivek. Over to you.
Thank you so much, Rohit. Thank you everyone for staying all this way till the end and to continue all the way as well until I finish and we conclude today's session. So before I start, let's give everyone a round of applause. Yeah. All right. Very good. Well done for staying all this way. I'm really glad to be here and to share with you what I believe is the best way to engage millennials. Now, you may be thinking, who are these millennials? Why are they important? Don't worry, I haven't disappeared. I'm still down here. If you look at the bottom left, I'm still down here. I hope you guys can see me, and I'm going to start right away. So, people tell me that there's no difference between millennials. We are all humans at the end of the day, right? But when I ask them a few questions, they get dumbfounded. So I'm going to ask you some of those questions as well to see whether you are keeping up with the millennials, whether you know the trends. So when I share these words with you, what I want you to do is in the chat, I want you to put 1 if you know what it means, right? If you know what it means, in fact, it'll be better if you can write what it means. And if you don't know what it means, you can put a question mark so that I know you don't know what those words mean, right? I only have 10 simple words, right? So for you, so let's begin. Okay. All right. So if you know what this means, please type it in the chat, right? Let me see some engagement from you guys. Come on. Okay. Yes. Tiffany. Well done, Tiffany. All right, what about the rest? Okay, if you don't know, you can always put a question mark, all right, so that I know that it's time to move on to the next word. All right. I think they're all now going to be copying answers. So I'm going to move on. Very well done. You only live once. That's right. What about salty? Do you know what this means? It's not the typical salt that we put in the food. What do they say when they say they are salty? Tiffany saying salty. So it seems like someone else is behind the computer. Yes, Tiffany is being salty. That means Tiffany's not feeling very happy. Okay. All right. What about this word? What is lit? It's not about lights, guys. It's something different. Do you know what this means? Oh, thank you. Alright, it's to be extremely good. Well done, well done. I can't tell your name, but well done. Yes, right. What about this? This is actually a phrase, right? This is a phrase. So if you know what it means, Tiffany, don't give away the answer. I know you know them all. So if you know what this phrase means, please share it in the chat. Okay, give others a chance to put a question mark if you don't know, right? It's very simple. I hope you guys are still at the screen. You haven't just left on the computer on and left, right? If you're there, please hit the question mark, right? Okay, if you don't know what it means, great. All right, and if you do know what it means, put the entire phrase down, type it out. Okay. Nope, no other responses. Okay, I'm going to move on. This is all right. Well done, Anisha. Not gonna lie. Okay, Rohit, well done. All of these guys are from the same gang. All right, well done. This one, it's a bit of a longer phrase, but we've just shortened it into, I think, 6 letters, right? So if you know what it means, put it in. If you don't know, put a question mark. Okay. Counting down to yes, well done. If you know what I mean, right? This is one long phrase, but we've shortened it into six letters. Okay, TLDR. You might have seen this on some blogs. I'll give you a hint. Okay, right. So, what does this mean? Okay, I see that most of you guys are struggling and even scared to put the question mark. It's okay to say you don't know, because that's where learning begins, right? So I don't know is a good space to begin. Okay, TLDR. Okay, TLDR is too long, didn't read. All right, if it's something's too long, you didn't read it, you just say TLDR. Okay, receipts are not your receipts you get from the shops, right? Not the ones you get from NTUC. It's actually proof. I have receipts to show that you have stolen money. Receipts, right? That's how they use receipts, because receipts are in a way a form of proof. Okay, goat is not the goat you eat for dinner, right? It's not that, it's something else. Those of you who watch soccer, you know what goat means, right? If you know what it means, put it in the chat. Yes, all right, greatest of all time, well done, right? So goat, if you hear a millennial say, oh, he's the goat, it's not condescending. It's like saying this guy is really the best. Okay, this one I really want you guys to understand that the reason I put the emoji is because it also means something, right? People will be thinking, why would they put a skull emoji? But the skull emoji is related to the word did. I mean, yes, but not just literally, but also figuratively as well. So what does did mean in millennial lingo? Do you know what it means? Okay. All right, laughing, yes, a lot of laughter. And the reason why they use that skull is because you can see all the 32 teeth and that's their way of expressing themselves, right? So it's really hard laughter. It's not the typical haha laughter. It's really rolling on the floor, laughing kind of a laughter, right? And we see this in social media as well, right? So this person is seeing the video, already wheezing watching the video, and then she puts that skull as the emoji, right? So you need to know what they mean when they put these kind of emojis. It's not RIP, it's not rest in peace, but it's actually something else, right? What about this one? This one's a little bit of an insult as well, but you need to know when they use it and what they mean when they use it. Okay, boomer. It's more of a retort, right? It's a retort to boomers who maybe are preaching and they don't want to fight, they don't have the energy to explain, then they just say, okay boomer, let's just leave it at that. Now this is how it gets used on social media, right? So tell me you're old without telling me you're old. And then this is an ad that Mr. Brown is showcasing, and the reason he showcased it is because he says that, you know, TikTok it's not spelled as literally TikTok, right? It's TIKTOK, right? But when you know that someone has spelled it wrongly, it's very clear this person doesn't know what TikTok really is, or hasn't kind of interacted with the platform, right? So that's why he put this. And okay boomer is basically telling him that, pretty clear you don't know the social media space, you don't know what the young generation is all about. So you might be wondering, okay, so it's very nice to know all these new lingo, and there's a lot more if you ask me, and I'm still learning, but what exactly recruits, rewards, and retains millennials? Before we go into that, right, first you have to understand, where do you fall in this entire space, right? Are you Gen Z? Are you a millennial? Are you Gen X? Yeah, Gen X. And are you a baby boomer, right? So it's good for you to know these things, because you don't want to go around calling someone a millennial without realizing you yourself are a millennial, right? Because that's what I used to do. I used to think that I'm not a millennial. I thought I was Gen Y, and then I was like, these millennials. But turns out when you do the research, you realize that actually I am the one who the Gen Ys have been renamed as millennials, right? So they renamed Gen Y into millennials because we hit the millennium while we were in our growing years. Okay, so next, the question I want to ask you guys today is, we've always had 4 to 5 generations working together in the workplace. So why is engaging millennials even the topic worth talking about? Why do millennials get all the limelight? Why are the ones that the newspapers and the news channel media talking about all the time, right? The key thing to understand is there are some trends that have happened that have led to this. First is the economical trend, right? The financial crisis happened, and because of that, right, we've realized a lot of our parents, the millennials' parents, were retrenched, right? You are retrenched because the company is not doing well. It's something similar that we are seeing even today, right? And back then, right, for the baby boomers, the success was the 1, 2, 3, and 4. One spouse, 2 children, 3-room flat, and 4 wheels, right? If you can achieve these things, you are pretty successful in society. So that was like the yardstick of success in Singapore, right, for the baby boomers. Okay, and I didn't say this, I didn't come up with this. This is by Singapore's then Senior Minister Goh Chok Tong, who said the Singapore dream was caricatured as the 1, 2, 3, 4, right? The 1 wife, 2 children, 3-room flat, and 4 wheels. Now, that also evolved when it came to the Gen X's. So for the Gen X's, for those of you who grew up in Singapore, you would be privy to the fact that, for them, success was the 5 C's. The 5 C's are like the car, the cash, credit card, condominium, and country club membership. Right, so these were the 5 C's that showcase that you are doing well in life, you're successful, you're making enough money, right? So these are all what we call assets, right? Assets that people can afford. Now, for the millennials, it turns out that they are not so keen about assets. In fact, they are pretty slow in settling down. They don't want to get married. They don't want to buy houses yet, right? They want to travel. So all of that is a you only live once mindset. So we've seen that even from our minister saying that the Singapore youths no longer drawn to the 5 C's. They have a very YOLO mindset. Now, what all of these things has done, especially the technology, right, is that it has changed our behavior. So what are some technological trends? And technology has been on a boom since we hit the millennium, right? So the internet came about, right? So the way we had phone calls, the way we took pictures, the way we took notes, the way we printed documents, the way we created documents, all of those things have changed drastically today, right? And we are seeing that everything is happening with a simple device called our smartphone. So the question to you is, have you realized how much has changed over the years, right? Because today it's about seeing how many people spend our eyeballs on social media. So if you're actually selling, right, and you are selling to millennials and Gen Zs, you have to realize that they are not looking for opportunities in the newspapers. They are spending a lot of their eyeballs on social media. You have to be there so that they know who you are and they get to understand who you are, right? So the number of people that's been just going on to these platforms to get entertainment is amazingly high. Okay, so the way we date has changed, right? Last time, dating means you see a person, you like them, and then you approach them and you ask them out for a date. Not so much anymore, right? Especially when Corona has happened, right? If you really want to find a date, let's just keep swiping left or right. When you match with somebody, right, then you can start a conversation, and then if you like them, you can always go out with them, right? So it's become a digital first approach. So your first impression is no longer made in person, it's made online. So dating has changed. The way we travel has changed. So no longer waiting in the hot sun, hoping a taxi will drive past you, right, so that you can flag them. Now it's just about opening an app, sitting in the air-conditioned room, waiting for the driver to reach, and then heading down, right? So that's how we travel these days. How do we get entertained? We entertain ourselves not by going so much to the movies when you are feeling lazy, right? You just sit at home in the comfort of your home, right? Put on your TV, switch it on, put on Netflix, and then binge watch a lot of the shows that they have. This is how we entertain ourselves. Okay, even the way we work, right? Today I'm talking to you through technology. It's not in person, but we are able to do that because of technology. So you realize how heavily dependent we are on technology, and imagine the millennials and the Gen Zs who have grown up with this, evolving together with them. That has helped them to realize that technology is not going to go away anytime soon. In fact, Google is their best friend. Anything they want, they go to Google and they ask their questions there, and then they get the answers there. They go to Google first before they come to you. Okay, so the millennials happen to be the first generation that didn't need an authority figure to access information unless they couldn't find those insights online. Okay, so all of this has also changed in the way we interact with one another, so the social trends as well, right? So there was a self-esteem movement that happened where we call it the helicopter parenting. So Nathaniel Branden, the author of The Psychology of Self-Esteem, he actually mentioned that we need to bring up the self-esteem of the millennials, and he wrote this book. It became a bestseller, right? And parents started to change the way they approached parenting. So even though a baby boomer may have been beaten up by his parents, right, they decided, I'm not going to do the same. I'm going to be a little bit more softer, right? Even though that was widely accepted in the US, it slowly trickled down into Asia, right? So the Asian parents were not as strict. They were still strict. I still got beaten up, right? But that they weren't as strict as their parents were. So there was a certain lower level of intensity when it comes to parenting. Okay, so basically they were a lot more supportive, right? So what we see here is that the maid is there to carry the bag and to ensure that the child is fully protected. So there was a checklist for them to do well, right? So are you getting into the right school, you're getting the right grades, right classes, are you getting into the right scores, the right CCAs, right, right volunteer work, so that you can get into the right schools, get the right certifications and stuff like that, right? This is what we call helicopter parenting. The parent is there to pave the path for them, and that's what we experienced, right, from our parents as well as millennials. And even the trophy generation, we are called the trophy generation because just to get people to participate in competitions, right, they would say you will walk back with a trophy even if you didn't win, right? So all of these things have had its impact on the mindset that millennials have. So typically parents prepare the path for the millennials and the Gen Zs instead of preparing them for the path. Now that is something that we have to realize. It's just we are all a consequence of the social conditioning that happened when we were growing up. So I want to ask you this question: how old were you when you got your first phone? How old were you? Type it in the chat, right? How old were you? I'm sure you remember this. How old were you when you got your first phone? I know I got my first Nokia phone when I was 16 years old, right? And that was pretty late considering my classmates who got it way earlier than I did. Okay, so I'm just going to quickly take a look at the chat. 15, all right, Rohit. Right, 8. Oh wow, that's really early. Okay, I want to know what the others have to say. Anisha, 7. Okay, I think you're going to set the record there, Anisha. I'm wondering if anyone says 2 or 3 here, because that kid looks like he's probably 2 or 3 years old. All right. Wondering what about the rest? How old were you when you had your first phone? Okay. The fact of the matter is this, right? People are growing with technology, and even parents are like, if If my child is going to keep quiet with the phone, I'm just going to give him a phone. I'm going to enjoy that. But what they don't realize is the long-term consequence of all of these things that happen. Okay, so what happens, right? The amount of distraction, right? I think this is a joke, but it also is kind of true, right? The bigger the screen, right, the more the distraction you have. And I found it to be true as well. I never used to spend so much time. The only entertainment I had with the Nokia phone is the snakes game. You know, the snakes game, that's the only entertainment I had, and I would get tired of it after a while. But today there are so many apps vying for my attention, and I get easily distracted because of these smart devices. Okay, we start our day and we end our day with phones, right? It's the first thing we see and the last thing. It's no longer your partner, it's no longer your girlfriend, it's basically the phone that you touch right before you go to sleep and when you wake up. Okay, so it also leads to what we call the blue tick anxiety. Now, do you know what a blue tick anxiety is? If you know, just put it in the chat, right? Blue tick anxiety is something that especially the millennials and Gen Zs probably face, right? And it's happened after WhatsApp has been introduced into our lives, right? So the blue tick anxiety is basically the whole feeling of I've sent a message, the person has read it, and they haven't responded. Why hasn't the person responded, right? Why isn't this person responding to me? And they get so anxious on whether the words they sent, was it wrong? Did I say the wrong thing? Could I have phrased it differently? Could I have said that in a better way, right? Did I say something that was offensive? This is what we call blue tick anxiety. When people see a message and they don't respond, it irritates them, it makes them angry, it makes them anxious, it makes them rethink all the actions. Sometimes they even delete the messages and then they rewrite it again, right? So this is something that we see because of technology as well, right? So instantaneous, we want everything instantaneous. So there's a joke, right? Just read it but won't reply, right? So they are following the Nike logo as well to show the double ticks of the blue tick that we see on WhatsApp. And it even changes the way we make jokes, right? So we create memes. So there's this meme here that says to people who reply late, if I wanted a reply after 2 days, I would have sent the message via a pigeon, right? It is because this is how we expect things to happen really, really fast. And when we don't see things happen as fast as they should or as what we expect, it becomes a problem. Okay, another joke as well. This is how now millennials interact with jokes as well. These are what we call memes, right? So 3 people will get it, but it's still worth it, right? And for those who understand what this joke is, you understand the relationship between a cassette and a pencil, right? If you know what it means, you know what it means, you know, if you know what I mean, right? So that's that. And millennials are also known for this thing called ghosting. So let's say you go out on a date, right? You had a great time, but one of you don't really like the experience, but you don't show anything, you don't reveal anything. In fact, you drop the person back home and then you simply disappear. So the other person thinks that, okay, I had a great time, when shall we hang out again? And then they blue tick you and they disappear and they block you sometimes if they don't want to hear from you again, and they don't give you an explanation why have they disappeared. Maybe you've experienced this with interviewees, maybe you've experienced this with your employees within your teams, maybe you've experienced this with people in a personal relationship. I definitely have experienced this amongst colleagues as well, who suddenly just disappear, especially with freelancers, right, who sometimes found a better gig and then they want to just move on to that and they don't want to give you an explanation. It's so much easier, no drama, I just ghost you, right? So if you are annoying, I just block you. And it is possible that, you know, all this ghosting is because we learn from technology. I can just block a person and I don't have to deal with the person anymore, but they don't understand the long-term consequences of ghosting. Okay, so all of these trends have shaped human behavior, it's shaped the way millennials behave. It has irritated a lot of the leaders who are unable to understand what millennials want. And that's why we say there is a generation gap that's much bigger today than it ever has been. So millennials and Gen Zs, they have this thing called shopping for a job, right? They basically apply for a job and they will only choose the organization that they feel has good reviews online, just like how you would, decide to pick a movie or decide to buy a product online. Even when it comes to a job, they are seeing the reviews of the organization before they decide. Okay, so this is the thing. A resignation shouldn't turn an employee into an enemy, and no employee promises lifetime loyalty, just like no business promises lifetime security. So the millennials have become a lot more loyal to themselves than to others, right? So for them, it's more about these reviews, because if you are unhappy with the organization, they treated you badly after you've tendered your resignation, they will go and write about it on Glassdoor and other websites like Indeed and LinkedIn, right? So what you want to do is to ensure that as an employer, you're a lot more engaging, exciting, and you appear on Google when they search for you. So what are some of the challenges that millennials and Gen Zs face, right? First is not being taken seriously, not getting enough respect, being perceived as entitled, a lack of patience, hardly getting any useful feedback, a lack of experience, not fully understanding what is expected from them and not knowing how to clarify that, miscommunication with older workers, rigid processes irritate them, and corporate culture shock when it's very different from what they have been used to, and the understanding of how can they prove their value to the organization. These are some of the challenges that they have indicated to me over multiple surveys of what are the issues that they face as an individual. So what does this mean for you who want to recruit, reward, and retain this young generation, right? First, you need to understand the 3 P's of employee engagement. Whoever they are, if they are under your team, you need to know how are they proactive, are they productive, and are they promotive. So proactive in terms of attitude, are they proactive in terms of getting things done, are they productive in the way they work, is their performance on par, and promotive, are they going to invite their friends over to your organization because they believe this is such a great place to work at, right? And these are the 7 fundamentals that I have kind of looked into, and I have segmented and dissected and put them all into my book. And I believe that these are the 7 areas that any young generation, be it millennials or Gen Zs, are looking for when they want to join an organization, stay there, and grow there, right? So these are the 7 areas. We have fulfillment, futuristic, forward framework, frequent feedback. We have friendship, fun, which is also called FlexiPay, and freedom. So today I'm just going to quickly touch on freedom, just one, because we don't have a lot of time, and then after that I will share with you how you can get to know all the others as well. Okay, so time is of essence, and you know that in the recent days after COVID, especially, employees are not willing to go back to the organization, and we also know this term called the Great Resignation, because if your organization, if your leader is saying everyone comes back to the office because I know you're not working at home, then they ask you, what do you think I was doing in the office, right? Because they know that it's not about how much time you spend in the office, it's about how productive you have been, right? So their idea of success and a measure of time is not just about having a salary and a job title, it's about having free time, liking what you do, a job title, mental health, physical health. All of these things are important for them, and they're looking for organizations who recognize that, right? So the longer you work, the more hardworking and productive you are. It doesn't apply to them. They don't believe it. They know that is a wrong measure of productivity, right? This is a viral post where this person, he's trying to hire millennials and Gen Zs, and it couldn't, because one person saying that his weekends cannot be touched, another person saying the office is too far, I'm not going to come over, another person saying I got a very high salary, I cannot take such a huge cut, another person saying can you give me an assistant so that he can help me out with some of the admin work, another person is asking for flexi benefits, so can you give me 21 days of leave instead of 14 days, another person was saying I need more flexi benefits, right? So can you give me 1 month instead of 1 week in terms of leave. And so we see a lot of negotiation happening amongst the younger generation because they believe in asking for what they want, right? They are very, very vocal in that sense. So the 9 to 5 is no longer seen as the go-to way of working anymore, right? In fact, the more freedom I have, the better the organization is, the more promotive they are of the organization, the more happier they are, the more engaged they are, right? So a lot of Singaporeans, in fact, admit that they stay back just to show face. That means it's because just to show that I'm not slacking off. And I think this is one of the things that they don't like. I just have to stay back, not because I have work to do, but because I don't want other people to think badly about me. So employees start quitting, right? That's why we see the great resignation happening in the US, and it's creeping up into Asia as well. It's very hard to find workers, right? So flexible working hours is one of the biggest things that's going to be engaging with the younger generation, right? Work-life balance is a huge part of it, right? Leaving on time and not working on weekends is what they're all looking for. Okay, so this is a stats, right, that 58% of their profile says they have been positively impacted by being able to have a flexible working policy. There's an increase in productivity, there's a boost in profits, and still organizations still believe that having people work in the office is a must. Okay, this is also seen by the 996, right? 996 is the 9 to 9 p.m. 6 days a week kind of a syndrome. It has been coined in China, right? And I believe that the Chinese developers, the software engineers, coined it, saying that this is a 9 to 9 6 days a week schedule, and we are getting hurt mentally, physically. It's affecting us. We don't want to be in that kind of a working culture anymore, right? So these are some case studies just to show you, right? So the Lo and Behold group, they believe that for every 5 years of work, employees get 1 month of paid leave, right? This is to incentivize them to stay and to give them a bit of bonuses as well, right? Another startup, Lo and Behold, also the same one, right? They believe that these young startups, they believe in giving them the freedom, right? So nobody polices your time. You can come in whenever you want, as long as you feel productive, but you must still meet the goals, right? So they give you the freedom, but you have to be responsible to take it in the right way. Okay, another case study of Optimate, right? They have less than 20 employees. Some of them are working remotely from China and India, and they also adopt a Silicon Valley culture, which is unlimited leave and the option to work from home, right? So all of these things are very exciting for millennials and Gen Zs, because you don't see this everywhere yet. It's not a commonplace practice anymore, right? In fact, even in Carousel, right, they openly talk about it on the website that the reason I joined Carousel is because of the flexible work arrangements and the diverse community that we have, right? The work-life harmony that I have, the career growth. So they talk about these things, about why I joined this organization, and it's important that we also showcase this on our company and recruitment drives. Okay, so it's all about being more task-oriented than time-oriented. That covers this first segment, but I don't have time to go through all of that, so I'm going to quickly wrap up, right? So millennials, there are 4 things you need to know: what motivates them, how they communicate, what are their unique strengths, and what are some of the unexplained expectations from the workforce. And that's why I wrote the book on engaging millennials, so that you can bridge the generational gap if you are finding it difficult to work with those younger than you. All right, so the employee engagement, as an announcement, I just like to say it's not the HR's responsibility, it's everyone's responsibility. So as a leader, you have to be the one who moves in and engages them on all these levels. Okay, so listen with data, get the data, ask them these questions like, why are you still here, what keeps you in this organization, and realize that in statistics wise, UK and Singapore, we are pretty unhappy in the workplace. So having that conversation on why are you still here really helps you to know what you are doing right. Okay, so this is all part and parcel of employer branding. Everything that you do, even as a leader, right, helps you to attract better talent, retain them, and reward them effectively. Millennials are known to be 50 times more likely to plan a long-term future at a great workplace. So please make your own organization a great workplace to be a part of. All right, with that, I'm going to end today's session. If you would like to share some feedback, if you'd like to access the slides, right, please do the feedback form. We'll share the link in the chat. All you got to do is click the link, and you will get to share the feedback. With that, I'm going to hand it back over to Rohit. Thank you.
Thank you so much, Vivek. Thank you so much, Vivek. I still have your book and I have read it. And I would highly recommend everyone to read this book. It's really, really good. So thanks a lot, Vivek. Thank you so much for your time. It was a lovely hearing you again. Let's watch the video and then we will wrap up.
Deepak is part of our community now, so it's really word of mouth. He's so amazing at what he does.
For one-on-one, he really explained, what their company do.
He was able to tailor, his solutions or recommendations to what was in my interest.
I think his honesty and clarity, he came across as someone you can trust straight away. He knew what he was talking, and he knew in a span of one meeting what we wanted. So we just felt that we could trust him and rely on him.
What I liked about Deepak is he's very personal. We swap WhatsApp messages on a weekly basis. We'll meet up. Everything's done in an informal way, which is how I like to have and build up that client relationship.
Having someone that can explain clearly, give me confidence on the plan we wanted to do, and the way he was able to match our expectation and the product was something that make me choose Deepak.
So I think for me, what's important in a financial advisor or consultant is someone I can trust, and someone I can trust to give me advice that's suited for me and my needs, and not, come in from a direction of selling services or selling products that I'm not comfortable with.
We definitely had two plans, one short term, what we want to achieve, and one the longer term. I wanted to have some flexibility, which I think GFC has in today's approach. So I think that really helped very well.
We are part of a network. You can trust him because if you let one down, it's a domino effect, but it's the opposite. So he helps out everybody, and he's quite popular in our personal community as well.
Thank you so much, Tiffany. So that was just a bit of testimonial from Deepak's clients. And as I said, this is more of a generic discussion. If you would like to have one-on-one chat with Deepak, we are more than happy to do it. So just either drop me an email or Deepak and we can schedule a call with him. So thanks a lot. Thanks everyone for attending tonight. And thanks to all the speakers. And have a great night. Good night. Thank you.